Hi and welcome to Trader's Edge. Today I'm going to explain you how to spot, analyze and trade with fair value gaps. Okay. This might sound complicated, but it's not, trust me. I'm going to teach you, so let's not waste any time and let's get started. First, we are going to learn how to spot the fair value gaps. Fair value gaps are basically price gaps in the market, where price likes to return to and continue the trend from there. You can spot fair value gaps on pretty much every time frame. But today we're going to look at lower time frames. You can also spot them on every chart, stocks, Forex, and crypto. Fair value gaps are very easy to spot. Simply search for a big candle. In this example we're going to look at a green one, then drag a box from the previous candle's high to the next candle's low. And there you go, you got your fair value gap. But keep in mind that if there is no space between the high of the first and the low of the last candle, it means there's also no fair value gap. Now, there are 4 scenarios that can happen now. Scenario 1, price simply continues to rise. We don't trade, let the market make another opportunity. This scenario isn't part of our strategy. Scenario 2, price retraces to the fair value gap. If so, we drag a Fibonacci tool over the box. Make sure it has the 0.618, the 0.5 and the 0.38 to levels. Then we wait for price to retrace to one of these levels. Optimally, it won't close below the 0.5 level and the low won't be below the fair value gap. In this case we would go long. Scenario 3, price breaks through the fair value gap and closes below it. Technically this would mean price doesn't respect the fair value gap anymore and will probably continue to go down. If you're an aggressive trader, this would mean you should go short. Scenario 4, price breaks through the fair value gap, goes a bit below it and retraces back to it. Then you simply do the steps in scenario 2. If the fair value gap is relatively big, you can wait for it to retrace to one of the Fibonacci levels, etc. But in this case we're just gonna look at the whole fair value gap. In this case we would go short. Now let's look at the bearish examples from scenario 2. Here we can see that it's exactly like a bullish fair value gap. But instead of the high of the previous candle, we take the low of and connect it with the high of the next candle. After the big candle, now, price behaves like in scenario 2, but in the opposite directions. It retraced to the fair value gap, made a hammer candle, not closing above the 0.5 level and then went further down. In the second example price created a huge fair value gap. That hasn't got touched once. Then, price came into the zone and showed bearish sentiment at the 0.5 level. But that's still not gonna be enough to make you a profitable trader. Without managing risk you will never be successful. So where are the best places to put your stop loss and take profit? Normally, putting the stop loss a bit below the fair value gap is the most optimal solution. For take profits I'd rather look for a good risk to reward ratio depending on your stop loss, or take hierarchy level or Fibonacci level. Now if you'd now just wildly started trading with these informations, you'd probably won't be successful at first, trust me. It takes time to get a feeling for the fair value gaps. They are a very strong tool that can help you pretty often, but also might not work every time. The best thing you can do right now is go on a chart and try to spot these fair value gaps and look how price behaved with these. So that's it for today's video. I hope you're gonna have success trading. Like and subscribe if you learned something new. Until next time.